Hello, everyone. Ken Tumolo with Tumolo Financial. This month's Tumolo Talk will have to do with RMDs and charitable giving. And I'm going to focus a little bit more today on charitable giving, just because I feel that's actually a good tool later on when you have to take those RMDs. For those of you that don't know, those RMDs, required minimum distributions, that's when the IRS requires you to take money out of those IRAs and 401ks. So the age has gone up a bit. There's a few law changes. Originally, if you remember years back, not too far back, the age was 70 and a half that you would have to start doing that. Then it went up to 72, and then a recent law brought it up to between 73 and 75, depending on your birth date, is the best way to put it. So RMDs, required minimum distributions, just means that that's the time the IRS requires you to take money out of those 401ks. On my screen to the right, you'll actually see that there's a uniform lifetime table. That's where you go to find out how much you have to take out. What they do is they give you a divisor. So what you're doing is you're taking your 401ks, your IRAs, and you're dividing it by that divisor. Percentage wise, the percentage goes up every year. So the lower the divisor, the higher the percentage. Just giving you a little math thing there. But really what they're trying to do is make you take more and more out so they can collect more and more in taxes. So for an example, if you have to take out 500,000 and you're age 73, actually, if your account is worth 500,000, in your age 73, when you do the math, you have to take out $18,867. So we help our clients with figuring that out. You can group like accounts. You cannot group unlike accounts, meaning when you're doing this, what you want to do is basically group all your IRAs together, total the amount between all of them, and then divide it by the divisor. And then you can actually pick which account you want to draw out of. So you can draw from the weaker of the accounts for the year, or you can draw from the account that sometimes it makes sense to draw to the better account for the year if it's a riskier account. So really, depending on your situation, will drive you towards which account to draw from. Charitable giving, and this is where you can actually help yourself out with those RMDs. If you're someone that normally gives to a charity, and I'll use the church example. Let's say you give 10,000 to a church every year, and with that previous example of having to take $18,000 out, you can actually have your custodian, the custodian of your IRA, so Fidelity, Schwab, TD, you can actually have them write the check directly to the charity. And guess what? No one pays taxes on that. You don't. But the plus is, if they write that $10,000 check to the charity and you were required to take 18,000 out for the year, you only have to take out 8,000 because that 10,000 counts towards your RMD. And think about this. Normally when you're giving, so for example, I'll use the church piece of it too. When you go to church, usually you're writing them a check or you're putting money in the basket. That's money that you're already paid taxes on. But instead, what you're doing is you're taking money from the IRA that you never pay taxes on, and then you're giving that to the charity. So it's actually, the charity doesn't lose out. They're still gaining because you're still helping them out, but you're also gaining too because you're not paying that extra tax piece. So big thing I'm going to stress, it has to be written directly from the custodian. And a lot of them have a form that you fill out, and the charities, especially the churches, they actually have a form that it's actually just a letter a lot of times that they send you with the information that you need for the form. So it's a common practice. They know about it. And so this way it's something that you have the ability to use. One thing that I'm going to point out, it was actually a rule that was in place with the old RMD rule, which was taking RMDs at age 70 and a half. So what the IRS did was they actually left it in play where you can start doing it at 70 and a half if you wanted to, even though you're not required to do required minimum distributions until age 73, between 73 and 75, I should say. There is a limit. It's up to $100,000 a year per person. So how can we help? So the RMD piece of it is always, I find that it becomes a mystery sometimes because it's just something different. Our whole life, we didn't have to take money out of those accounts. Maybe we did to get through retirement or as part of our income. But when the time comes and we actually have to take a required minimum distribution, we have to go to a table. We want to make sure you're doing it right. So if you just have a question on RMDs and you need a little bit of help, feel free to contact us. You can call us at our main number, the 860-650-3005. Send us an email. We're here to help. We're going to put out more Tumolo talks as well, most of you know, we've been doing it monthly, but it's really just helping, giving you a little bit something, teaching. We enjoy doing it. So thank you. And again, if you have any questions, feel free to reach out.